How many of the companies in your long-term portfolio today will still exist as independent companies in 20 years? The math says about half. Not because they will fail, because they will be bought, broken up, or absorbed. That includes the Apples, the Microsofts, the dividend aristocrats, whatever your version of the list is. And yet, the index those same companies sit inside has compounded at roughly 10% a year for nearly 70 years, while the companies inside it kept disappearing. Most investors assume a self-built portfolio of blue chips and an index fund are basically the same thing with different fees. They aren't. The popular advice to buy great companies and hold forever works at the index level and quietly fails at the individual stock level. By the end of this video, you will know exactly where the failure happens, how much of your long-term return it can cost you, and what to do with the part of your portfolio you genuinely plan to hold for decades. Hi, I'm Oksana. I've spent over a decade in institutional capital markets. Let's get into it. In 2015, 4 researchers at the Santa Fe Institute published a paper called The Mortality of Companies. They took the CompuStat database, which tracks publicly traded North American companies going back to 1915, and ran several analyses on more than 25,000 of them. They took the database, which tracks publicly traded North American companies going back to 1950, and ran survival analysis on more than 25,000 of them. Survival analysis is normally used in clinical medicine or ecology. It is how you measure how long patients live after a diagnosis or how long a population of organisms persists in an environment. The researchers applied the same statistical methods to companies. The finding: publicly traded companies die at a roughly constant rate. The probability of a company disappearing in any given year doesn't really depend on how old the company is or what sector it operates in. A 5-year-old company and 50-year-old company face a broadly similar annual probability of existing. When you have a constant rate like that, the distribution of lifespans follows the same math as radioactive decay. The researchers says this explicitly. They describe their framework as inspired by a decay process, where the decay rate is proportional to the number of remaining constituents. That is exactly how radioactive isotopes work. The headline number, the half-life of a public traded company, is about 10 years. From any group of public companies trading today, roughly half won't exist as independent public companies in a decade from now. Take whatever's left, and a decade after that, half of that group will also be gone. That number gets quoted a lot. It also gets misread a lot. Before we apply it to your portfolio, we need to be precise about what it actually says, because the misreading is what makes people dismiss it. In 2000, General Electric was the most valuable company in the world. It had been a fixture of American investing for over a century. On the Dow Jones since 1907. For an entire generation, GE was the textbook great company you hold forever. It was the kind of a name a respectable broker would put in a portfolio with absolute confidence, and the client would thank him for it. Over the next 2 decades, the stock lost most of its value. GE was removed from the Dow in 2019, and in 2024, the company broke itself into 3 separate businesses: GE Aerospace, GE Vernova, and GE Healthcare. Anyone holding GE as a long-term core position ended up with 3 different stock positions in 3 different industries, none of which is the company they thought they bought. GE didn't go bankrupt. There was no scandal, no fraud, just decades of dominance, then decline, then restructuring, then a three-way split. The normal endpoint of the process the Santa Fe paper describes. This is what death means in the study. The researchers are tracking exits from the database, companies that stop existing as independent public companies for any reason. When you look at the breakdown between 1950 and 2009, the largest category by far is mergers and acquisitions, at about 45%. Bankruptcy is only about 4.5%. The rest is a mix of going private, delistings, liquidations, and reorganizations. So the half-life finding is not half of public companies go bankrupt every decade. It's half of them stop being independent public companies every decade, mostly because someone bought them, broke them up, or absorbed them. The names you know today are not stable objects on a long horizon. They are temporarily large, temporarily independent, and temporarily themselves. Now let's apply that to the most famous index in the world. The S&P 500, in its current 500 company form, was launched in March 1957. On its 50th anniversary in 2007, Standard & Poor's published how many of the original constituents were still in the index. The number was 86. Out of 500 companies handpicked in 1957 to represent the largest publicly traded American businesses, only 86, about 17%, were still in the index half a century later. By more recent counts, the number of true original survivors has dropped further into the 50s or low 60s, depending on how you treat name changes and spin-offs. Somewhere between 88 and 90% of the original 1957 constituents are gone from the index. And these weren't fringe companies. They were the bluest of the blue chips. US Steel, Bethlehem Steel, Polaroid, Kodak, Pan Am. Names a respectable broker in 1970 would have put in a portfolio with absolute confidence, exactly the way someone would put GE in a portfolio in 2000. Meanwhile, the index itself has gone from its 1957 launch to today, delivering long-term returns that consistently beat the vast majority of actively managed funds trying to outperform it. The index lasted. The companies inside it, on average, didn't. Hold that in your head. The thing that compounded was not the companies. It was the structure around the companies. The popular explanation for why the S&P 500 is good long-term investment usually goes something like, you are buying the 500 best American companies. They are the strongest, most profitable, most dominant businesses in the world. Of course they keep compounding. That explanation can't be right. The 500 companies in the index today are not the 500 that were there in 1957 or 1980 or 2000. The names underneath have been changing constantly. If the returns came from the specific companies, the returns would have stopped because those companies left. The actual mechanism is simpler. Imagine two investors in 2000. Both have $100,000. Both want long-term US equity exposure. Investor A picks 10 of the largest American companies of the day. These were not random names. These were the actual consensus winners. GE was the world's most valuable company. Cisco was the poster child of the internet boom. Then there was Lucent, Citigroup, AOL, and 5 more companies of similar stature. Investor B does something much simpler. He puts the same $100,000 into a fund tracking the S&P 500. 25 years later, Investor B's portfolio has compounding along with the index through the dot-com busts, the financial crisis, COVID, all of it. Every time one of the names in their fund declined, got acquired, or fell out of the index, it was quietly replaced by something that met the criteria. They didn't transact, they didn't pay tax on the swap. The replacement happened inside the wrapper. Investor A is sitting on a different outcome. G has split into 3 pieces. Cisco only just clawed its way back to its March 2000 share price at the end of last year. Lucent was absorbed into Alcatel, then into Nokia. AOL destroyed itself in the Time Warner merger. Citigroup nearly went under in 2008 and has compounded at roughly 2% a year ever since, against 8% for the index. Of the 10 consensus best names of 2000, half delivered outcomes ranging from disappointing to catastrophic over the next 25 years. The other half did fine or better than fine. The point is that you couldn't tell which was which in 2000, and neither could anyone else. Investor A didn't pick badly, they picked the consensus top of the market. The half-life worked on their portfolio in full. An S&P 500 index fund is not a buy and hold position in 500 specific companies. It's a buy and hold position in a rule. Hold the largest, most liquid, profitable US-listed companies in proportion to their market capitalization. S&P's Index Committee applies that rule on an ongoing basis. The investor never has to make a sell decision. The index is built to absorb the half-life. A static portfolio of stocks is not. This is also why the scorecards, which track active managers against their benchmarks, show roughly 85 to 90% of active US large-cap funds underperforming the S&P 500 over a 15-year horizon. Even professionals with full-time research teams struggle to beat the rule because they're trying to outpick a system that is structurally designed to do the picking for them, continuously, with no taxes and no fees. When you hold an index for 30 years, you're not betting that any specific company will dominate for 30 years. The data says the bet has bad odds. You're betting that the US economy will keep producing large, successful public companies, and that the index methodology will keep selecting them as they emerge and removing them as they fade. That's a far more robust bet than picking individual winners. So here is where the failure happens, how much it costs, and what to do about it. Where it happens. The failure isn't the choice of companies. Investor A in 2000 didn't pick badly. They picked the consensus best names of the entire market. The failure is the structure. A self-built portfolio of individual stocks has no replacement mechanism. When a holding declines over a decade, the investor keeps holding it all the way down unless they actively sell. The index has the problem solved by design. A hand-built portfolio of names, however carefully chosen, doesn't. How much it can cost? If 3 of 10 names in a long-term portfolio go the way of G, that's a 30% drag on the portion of capital those names represented, with no replacement mechanism to recover it. Compounded over 20 or 30 years, the gap becomes the kind of a number that changes a long-term outcome. And here is the part most people miss. When you hold an index fund, you're not actually buying companies. You're buying a rule about which companies to own. The rule is what survived 70 years. The companies inside it never did and never was supposed to. There is a fundamentally different kind of instrument than a portfolio of names you picked yourself, even if the names overlap on day one. One is a basket, the other is a self-updating construction that quietly fires its worst constituents and recruits the next generation without even asking permission. Both can have a place. Concentration is often how wealth gets created by founders, by early investors, by people with real information advantages. Structures like the index are how it gets preserved across timescales no individual can outlast. The core mistake is confusing one for the other. If this was useful, subscribe to Mass Portfolio. I make videos about how money actually works, the mistakes that cost people the most, and how to think more clearly about your financial decisions. Question for the comments. Which untouchable company today you think will look like G in 20 years? Drop the name in the comments below. And I hope this is not NVIDIA. I'll see you in the next one, and remember, money isn't a one-time thing, it's a habit. Bye.